So one important remaining concept that needs to be covered is that of depreciation. And this is something that will be very important when you go into capital budgeting. So we're going to have a look in this video at what it is and overview the two main methods of calculating it, which are the straight line and diminishing value methods. So imagine the following scenario. A business purchases equipment for $1 million, and it's got 20 years over which we expect it to be useful, after which it'll lose all of its worth. So we assume the equipment is going to break down and no longer be usable after this time. How are we going to record the loss of this equipment? The simple way to do this would be, in 20 years, when it stops being useful, so when it breaks down or whatever, we would record a debit of, we'll say, a loss expense, because we're certainly not going to debit assets or liabilities, for $1 million. And of course, simultaneously, we'll credit equipment for $1 million. So that would be the simple way to approach the problem. But there is a big problem with this. For the 20 years that we're using the equipment, we assume it's going to be helping us generate revenue. And when we have a look at our profits over this time, it's going to seem deceptively high, because we're going to have all this revenue but no corresponding expenses. That is, up until that year at the end, in which all of a sudden there's going to be this huge expense of $1 million that's going to make it look as if the company did very badly in that year, which is really not the case. We want to observe what we call the matching principle, which says that when we record revenue, we also want to record corresponding expenses. So instead of recognizing the expense only at the end of the 20 years, because that expense actually corresponds to the entire 20 years worth of revenue, we want to sort of spread it out and recognize it in each year. So this is why we use depreciation. Instead of waiting 20 years to recognize this, we say every year we will record the following. We will debit depreciation expense for some fraction of the cost of the equipment. And of course, at the same time, we will credit equipment for some fraction of the value. So instead of just recognizing it as being instantly lost, we are going to say every year it loses a fraction of its value until eventually it goes all the way down. The only question remaining then is, what actually is the amount going to be each year? What is that fraction going to equal to? So the two main methods we have for calculating this, first off, we've got straight line depreciation. So as you can see, we recognize the value of the asset as decreasing at a constant rate until it hits, in this case we've got it as hitting 0, but bear in mind, typically you would have some form of salvage value. So the idea is that at the end of its useful life, we will still be able to sell it off, maybe just for scrap metal or something like that. But the point is ultimately that it decreases at a constant rate. So how do we calculate the depreciation? It's just the cost initially minus the salvage value, which we could put at 0. And so this difference will represent the total loss in value over the life of the asset. And then of course we just divide that by years of life of the asset. Alternatively, you've got what we call the diminishing value method of calculating depreciation. So in this case, as you can clearly see, it doesn't go down in a straight line, but drops off more sharply in the beginning and then curves out. What's happening here is that we assume that the asset depreciates at a sort of a constant rate, but not constant in the sense of the straight line one, but you would take a percentage, say we call it depreciating at 20%, and each year you would apply that rate of depreciation to the current value. So it's current value multiplied by the rate of depreciation. And so you can imagine if it was initially worth $1,000 and it depreciated at 20%, in the first year that would be $200 of depreciation, taking it down to $800. Then you would say 20% of $800 is how much you would depreciate in the second year, which would be a smaller amount, and then 20% of some smaller number in the third year. And so each year it would be a smaller number that it depreciates by. So to finish up, we'll just have a look at an example. So looking at the equipment we mentioned earlier, which was here, we purchase equipment for $1 million and it lasts for 20 years, but instead of saying it becomes worthless at the end, we assume that it has a salvage value of $200,000. Using the straight line method, what would be the annual cost? So as we said before, we take the initial cost, which was $1 million, we subtract the salvage value of $200,000 in order to get the total loss of value over the life of the asset. And then of course we divide that by the number of years, which we said was 20. So this would come out to annual depreciation of $40,000. So what we would record every year was a debit of depreciation expense amounting to $40,000. And of course, we will credit our equipment for $40,000. And so this would apply every year, and the recognized value of the equipment would just drop and drop and drop until it reached $200,000. And then maybe we would sell it off, and so we would just be exchanging that equipment for cash. And that would be the end of it. So that's the basics of depreciation.
Cut study time with concise video summaries by top students. Visit spoonfeedme.com to view more free videos in this course and hundreds of others.